$100 days are going to be the norm. $1,000 weeks are not going to be unusual, and they'll be more and more frequent as we move along. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. I had a conversation with our friend Jim Rogers, one of the greatest traders in general, and certainly one of the greatest commodity traders of all time. And I said, Jim, we were down in the Dominican Republic. I said, Jim, you buying gold? And he said, no. He said, I've got gold. I'm keeping the gold I have. I'm not buying more right now because it hasn't hit bottom. And then nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, you have to expect that. It's true of all commodities. Well, taking that advice, I then, looked at the charts. Well, starting 1900, if you say, okay, it was 250, it was 1999. 1900 was August 2011. So there was that gain. 250 to 1900. So there was that gain of $1,650 an ounce of gain. Take half of that, that's 825. And so when I saw 1050, I said, bingo, there's the 50% drawdown. It's exactly what Jim Rogers said would happen. That's the bottom. And it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000% and the second bull market was up 700%, if you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, puts you at $15,000 an ounce in 2025. The other thing that people don't understand, Robert, is just this is sixth grade math. You don't need calculus for this. So how much, I said prices of bonds go up when interest rates go down, which is true. How much? Well, the answer is it's not constant. It varies depending on the level of interest rates, something called the DV01, the dollar value of 1 basis point. How much does my bond go up for every 1 basis point decline in yield? Well, so let's say I cut interest rates from 9% to 8.75. That's a 25 basis point cut. Let's say I cut interest rates from 25 basis points to 0. That's a 25 basis point cut. Those two 25 basis points do not produce the same gains. The second one produces a much larger capital gain because the DV01 is higher. So in other words, when you're at low levels of rates, which we are right now, every basis point decline in rates produces a bigger capital gain than if the same thing were happening at higher level of interest rates. So this could be one of the greatest bond market rallies in history, starting from 70 basis points. If you get to negative 1% yield maturity through secondary market trading, those are huge capital gains. So don't.
Right. So you're saying if the bond rates keep going down, bond prices keep going up.
Capital gains, well, not yet, yes, but not only do they keep going up, they go up faster when rates are this low.
Good.
So your capital gains potential is huge. Now, your original question, Robert, was, well, what about gold versus bonds? What's up there? To me, I don't have to resolve that debate because I would say have both. Of course I like gold and I recommend gold, but I recommend 10%. Some investors are higher, seasoned to taste. But the point is, if you have 10% in gold, you've got the other 90% of your portfolio. What are you going to do with that? Well, I would have a slice for 10-year treasury notes for the reasons we just discussed. I'd have cash. There's room for equities and alternatives and all that. But you can have bonds and gold side by side, and that may be an ideal portfolio.
Is it accurate with you, the more that the price or the yield on bonds or your interest on bonds goes down, doesn't that affect the price of gold?
It's generally correct. So if bonds are competing with, sorry, if gold is competing with money markets, let's say, well, let's flip from bonds to the money market because that's the most liquid form. Money market funds, bank CDs, short-term investments, etc. If gold is competing with these money market or substitutes of money market funds, and their rate is zero, and gold's yield is zero, then it's a fair fight. Now it's all about capital gains. Now, obviously, we already talked about in the last segment how you can make 10 times your money in capital gains on price of gold. But if you're comparing yield to yield, even assuming the price is going to be constant, it's a fair fight. If they're both at zero, then take your pick.
A lot of gold and a lot of silver, just because we saved money in gold and silver. We just kept using debt to get rich.
Sure. Well, you kept issuing debt, but now we're talking about buying debt.
Correct.
Correct. And for the investor, for someone with money, absolutely have your gold and silver, but I'd have some treasury notes side by side because they're set up for very large capital gains because interest rates are going to go even lower. And the people say they can't go lower. My answer is, just watch because Germany has negative rates. Japan has negative rates. The U.S. still has positive rates. Rates could go a lot lower.